Hello friends, welcome back to the channel, and if you were born before 1964, I need you to hear what I am about to say. There is a very strong chance that you have been paying more tax than you legally owe, not for 1 month, not for 1 tax year, but potentially for several years running, and HMRC is not going to ring you up and tell you about it. That is not how the system works. The system takes. It does not tap you on the shoulder and offer it back. I have spent the past week going through HMRC's own published guidance, the current tax code structures, the allowance thresholds for this tax year and the 4 years before it, and the specific refund processes that are open right now. And what I have found is that there are 5 distinct ways people born before 1964 are routinely overpaying tax. 5 refunds that could be sitting in the system right now with your name attached to them, and in most cases all it takes is 1 form, 1 phone call, or 1 online claim to get that money back into your account. I am going to walk you through every single one of them today. I am going to give you the figures, the steps, and the exact forms you need. No jargon, no filler, just the information that should have been put in front of you years ago and was not. Now, before I get into it, I want to say something to those of you who are already subscribed to this channel. Thank you. You are the reason I make these videos. You understand that when HMRC updates its rules, when allowances shift, when new claim windows open or old ones close, they do not send you a personal letter explaining what has changed. They update a page on gov.uk, they adjust a line in a tax code, and they assume you will notice. The people who subscribe to this channel notice. The people who do not subscribe find out when the deadline has passed and the money is gone. So if you are watching right now and you are not subscribed, do it now. It costs nothing, it takes 1 tap, and it means the next time something changes that affects your money, you will know about it before it is too late. Now let me walk you through the 5 refunds, and I want you to stay all the way through because number 5 is the one almost nobody knows about. It is the one that involves the most money, and it is the one that has a hard deadline that cannot be extended once it passes. Let us get into it. The first one is the most common, and it is the one that catches the most people without them ever realizing it has happened. It is your tax code. If you were born before 1964, you are now at least 61 years old. Many of you are already retired, drawing a state pension, possibly a workplace pension on top of that, perhaps a small private pension as well, and some of you are still doing part-time work alongside all of it. Here is what most people do not understand. Your state pension is taxable income, but it is paid to you without any tax being deducted. That means the tax you owe on your state pension has to be collected somewhere else, and the way HMRC does that is by adjusting the tax code on your other income, your workplace pension or your part-time earnings, so that more tax is taken from that source to cover the state pension as well. The problem is that this adjustment goes wrong far more often than HMRC will ever publicly admit. If your income changes, if one pension starts or stops, if your state pension is uprated, the tax code on your other income is supposed to update automatically. In practice, it frequently does not. The result is that you are either overtaxed because the code is collecting too much, or undertaxed and a bill arrives months later that you were not expecting. In both cases, you are the one who suffers, and in neither case does HMRC volunteer the correction. The action you need to take is this. Log into your personal tax account on gov.uk or ring HMRC on 0300 200 3300 and ask them to confirm that your tax code is correct for every source of income you currently receive. Do not assume it is right because it has always been that way. Check it every year. The second refund is marriage allowance, and this is the one that I believe is the single most underclaimed tax break in the entire country. If you are married or in a civil partnership, and one of you earns less than £12,570 a year, which is the current personal allowance, while the other is a basic rate taxpayer, you can transfer £1,260 of the lower earner's personal allowance to the higher earner. That transfer reduces the tax bill of the higher earner by £252 every single year. Now here is the part most people miss. You can backdate that claim for 4 full tax years, 4 years at £252 each. That is a lump sum of over £1,000 landing in your account in a single payment. If your spouse has passed away, you can still claim marriage allowance for any tax year in which you were both eligible, going back those same 4 years. The form is free. It takes 10 minutes online at gov.uk, and HMRC will process the refund directly into the nominated bank account. There is no interview, no assessment, no income check beyond confirming that the lower earner was below the personal allowance threshold. It's one form, over £1,000, and millions of couples who qualify have never applied. The third refund is one that hits people the moment they access their pension pot, and most of them do not realize they have been overcharged until it is nearly too late to act. When you withdraw money from a defined contribution pension, whether that is a lump sum or a series of withdrawals, HMRC does not know in advance how much you are going to take out that year. So for your very first withdrawal, and sometimes for subsequent ones, they apply what is called an emergency tax code. What that means in plain English is this: if you withdraw £10,000 in a single month, HMRC's system treats that withdrawal as though you are going to earn £10,000 every single month for the rest of the tax year. It taxes you as if your annual income is £120,000. You are not earning £120,000. You took one withdrawal, but the system does not know that, and so it overtaxes you, sometimes dramatically. I have seen cases where people lost 30, 40, even 50% of a withdrawal to emergency tax that they did not owe. The money does not vanish. It sits with HMRC and it is yours to claim back. You can either wait until the end of the tax year and file a self-assessment return, which can take months, or you can act immediately using one of 3 HMRC forms. If you have emptied your pension pot completely and are not receiving any other income, use Form P50Z. If you have emptied your pot but do have other income, use Form P53Z. If you have taken only part of your pension and are not planning further withdrawals that year, use Form P55. These forms are available on gov.uk. Fill one in, send it off, and HMRC should process your refund within 30 days. Do not leave that money sitting with them. It is yours. The fourth refund is about the tax you are paying on your savings interest, and this one affects an enormous number of people born before 1964 who have been quietly putting money aside for decades and are now watching that interest get taxed when it should not be. Since the 2016 tax year, a basic rate taxpayer can earn up to £1,000 in savings, interest completely tax-free. That is your personal savings allowance. If you are a higher rate taxpayer, the allowance is £500. If you are a non-taxpayer, meaning your total income is below the personal allowance, you should be paying 0 tax on your savings interest, none at all, up to £5,000 under the starting rate for savings. The issue is that some banks and building societies have historically deducted tax at source, and if your circumstances changed, if you retired and your income dropped below the threshold, that tax should never have been taken. You can reclaim overpaid tax on savings interest by completing Form R40 and sending it to HMRC, and you can go back, again, 4 full tax years. If you have had a savings account paying interest for the past 4 years, and your income was below or near the personal allowance for any of those years, there is a very real chance that tax was taken that should not have been. One form, 4 years of potential refunds. And the fifth one, and I told you to stay for this, the fifth one is the refund that nobody talks about, and it is the one with the hardest deadline. If someone you loved has passed away, a spouse, a parent, a close family member, and that person was overpaying tax at the time of their death, that overpaid tax does not disappear. It belongs to their estate. It belongs to the people they left behind, and it can be claimed. As the executor of the estate, or as the next of kin, if there was no formal will, you have the right to contact HMRC and request a review of the deceased person's tax affairs for the 4 tax years prior to their death and for the portion of the tax year in which they passed away. If tax was overpaid in any of those years, HMRC is obliged to refund it to the estate. This includes overpaid income tax, overpaid tax on pension withdrawals, unclaimed marriage allowance, and unclaimed relief on savings interest. Every single one of the refunds I have just described in this video can also be claimed on behalf of someone who has died. But here is the deadline. You must act within 4 years of the end of the tax year in which the overpayment occurred. Once that 4-year window closes, the money is permanently lost. It cannot be recovered. It does not roll over. It is gone. I have spoken to people who discovered a deceased parent had been overtaxed by thousands of pounds across multiple years, and because nobody told them they could claim, because nobody explained that the right existed, the window closed and the money stayed with HMRC. Do not let that be your situation. If you have lost someone in the last 4 years, ring HMRC's bereavement helpline on row 300 200 3300. Tell them you want a tax review of the deceased's records and ask them to check every year that is still within the claim window. It is your right. It is their obligation. Use it. So let me bring this all together. 1. If you have a state pension and another source of income, your tax code may be wrong, and you need to check it by logging into your personal tax account or ringing HMRC directly. 2. Marriage allowance lets you transfer £1,260 of personal allowance between spouses. It can be backdated 4 years, and it is worth over £1,000 in a single claim. 3. If you have withdrawn money from a pension pot and emergency tax was applied, you can reclaim it immediately using Form P50Z, P53Z, or P55. 4. If your savings interest has been taxed and your income was below or near the personal allowance, Form R40 lets you claim that tax back for 4 years. And 5. If a loved one has passed away and was overpaying tax, you have 4 years from the end of the relevant tax year to claim that money for their estate, and once that window closes, it is gone for good. 5 refunds, 5 forms or calls, money that is legally yours, or money that belongs to the memory of someone you have lost. And in every single case, the only thing standing between you and that refund is knowing it exists and taking one step. If this video helped you today, I am going to ask you to do 2 things. Subscribe to this channel so you never miss information like this again, and share this video with someone you know who was born before 1964, a parent, a sibling, a friend, a colleague who has just retired. You do not need to explain the whole video, just send them the link, because one share, one conversation, one moment of looking out for someone, that could make a real difference. Thank you for watching, friends. I will see you in the next one.